You wake up on the first morning of retirement. No alarm, no commute. You made it. You pour yourself a coffee. You sit down at the kitchen table, and for the first time in decades, the day is yours. Then, about 3 months later, something shifts. You get a letter from the IRS. It is not a simple notification. It is a review of your retirement account withdrawal. They want to know why you took out a large sum. They want documentation. Or maybe it is your Medicare premium that suddenly jumps, and nobody told you that was coming. Or maybe it is the first time you file taxes in retirement and your tax bill is significantly higher than you expected. Your Social Security is being taxed, your IRA withdrawal pushed you into a higher bracket, and a decision you made in January is going to increase your Medicare bill in 2028. You sit there thinking, I did everything right. I saved, I planned, I retired. Why does it feel like the rules just changed? Here is the truth. They did. The moment you retire, the IRS does not forget about you. In fact, 5 specific financial situations are treated differently from the moment your paycheck stops. And most retirees have no idea this is happening until the consequences have already arrived. Stay with me, because by the end of this video, you are going to understand exactly what changed and exactly what to do about it. I am Jocelyn. I am a senior policy analyst and retirement finance expert, and this channel exists to make sure that the rules affecting your retirement, the ones the IRS, SSA, and Medicare never explain clearly, are something you understand before they cost you money. Today, I am walking you through the 5 major shifts that happen the moment you retire. These are not theories or opinions. These are official IRS, SSA, and Medicare rules verified directly from government sources and from AARP and the Kaiser Family Foundation. By the end of this video, you will understand why your Social Security may suddenly become taxable, when your required minimum distributions begin, and what happens if you miss them, why Medicare premiums can spike after a large withdrawal, and how the Social Security earnings test works if you are still bringing in income. And please stay until the end, because there is one hidden mistake, one timing decision that sounds completely reasonable, that forces seniors to take 2 full years of taxable withdrawals in a single calendar year. It is one of the most expensive errors I see retirees make, and I am going to show you exactly how to avoid it. Let me start with a story. I want to tell you about Robert. Robert is 73 years old. He lives in Tucson, Arizona. He spent 38 years working as a structural engineer. He was careful with money his entire career. He maxed out his traditional IRA contributions for decades. By the time he retired, that account had grown to just over $500,000. Robert knew about required minimum distributions. He had read about them. He knew that at some point, the IRS was going to require him to start taking money out of his IRA whether he wanted to or not. What he did not fully understand was the timing. He turned 73 in October of 2023. His financial advisor told him he had until April 1st of 2024 to take his first RMD. That was technically true. What the advisor did not emphasize clearly enough was what would happen next. Because Robert delayed his first distribution to March of 2024, which was before the April 1st deadline, he now had to take a second RMD by December 31st of that same year. 2 full years of required distributions in a single calendar year. 2 large taxable withdrawals hitting Robert's income at the same time. The result? Robert's combined income for 2024 pushed him into a higher federal tax bracket. It increased the portion of his Social Security that was taxable. And because Medicare looks at income from 2 years prior, Robert's Part B premiums jumped significantly in 2026, a consequence he never saw coming from a decision he made in early 2024. Robert did not do anything wrong. He followed the rules exactly. He met both deadlines, but he did not understand the downstream effects of the timing choice he made. And that choice cost him thousands of dollars. That is exactly the kind of thing I want to protect you from today. Let me walk you through the 5 major ways the IRS and federal benefit programs treat your money differently the moment you retire. Everything I'm about to share comes directly from IRS.gov, SSA.gov, Medicare.gov, AARP, and the Consumer Financial Protection Bureau. Change number 1, required minimum distributions. Under the Secure 2.0 Act, if you turned 72 after December 31st, 2022, your RMDs begin at age 73. If you were born after December 31st, 1960, your RMD age will eventually be 75. Your first RMD must be taken by April 1st of the year after you reach the required age. Every distribution after that must be taken by December 31st each year. The formula is straightforward. You take your account balance as of December 31st of the prior year and divide it by a life expectancy factor from the IRS Uniform Lifetime Table. That gives you your required minimum withdrawal for the year. If you miss an RMD, the IRS imposes a 25% excise tax on the amount you should have withdrawn. If you catch and correct the mistake within 2 years, that penalty may drop to 10%. But either way, you still owe ordinary income tax on the amount itself. Here is the hidden detail that caught Robert. Delaying your first RMD to April 1st of the following year is allowed, but doing so forces 2 RMDs into the same calendar year, one by April and one by December. 2 distributions, 2 taxable events, all in 12 months. RMDs apply to traditional IRAs, SEP IRAs, simple IRAs, 401k plans, 403b plans, and most employer-sponsored retirement accounts. Roth IRAs are not subject to RMDs during the original owner's lifetime. Change number 2, Social Security taxation. This one surprises almost every new retiree. Social Security benefits are not automatically tax-free in retirement. The IRS uses a formula called combined income to determine how much of your benefit is taxable. Combined income equals your adjusted gross income plus any non-taxable interest plus 1/2 of your Social Security benefits. If you file as a single taxpayer and your combined income exceeds $25,000, up to 50% of your benefits may become taxable. If it exceeds $34,000, up to 85% may be taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000 respectively. And here is the important context. These thresholds have not been adjusted for inflation since 1983 and 1993. That means more retirees cross these lines every single year. Not because they are wealthy, but because inflation has made even modest retirement incomes look higher in raw dollar terms. A large IRA withdrawal, an RMD, or a pension distribution can push your combined income above these thresholds and cause a significant portion of your Social Security to become taxable in that same year. Change number 3, Medicare IRMAA adjustments. IRMAA stands for Income-Related Monthly Adjustment Amount. It is the mechanism by which Medicare calculates your Part B and Part D premiums based on income. Here is the critical detail. Medicare does not look at your current income. It looks at your income from 2 years prior. So, a decision you make about your retirement account in 2024 will affect your Medicare premiums in 2026. In 2026, standard Medicare Part B premiums are approximately $204.40 per month. But if your modified adjusted gross income exceeds $103,000 for a single filer or $206,000 for a married couple, your premiums increase through IRMAA surcharges. At the highest income bracket, those premiums can reach $443.90 per month. For many retirees, this is an invisible consequence of taking large lump sum withdrawals or delaying their first RMD in a way that doubles up distributions. They make a decision today and get a surprise bill 2 years from now. Change number 4, how IRA and pension withdrawals are taxed. This one is straightforward but often misunderstood. Withdrawals from traditional IRAs and most employer-sponsored pension plans are taxed as ordinary income in the year you receive them. They are not taxed at the lower capital gains rate. They are added to all of your other income for the year and taxed at your marginal income tax bracket. Roth IRA qualified distributions are generally tax-free if the account has been open for at least 5 years and you are at least 59 and a half. But withdrawals from a Roth before those conditions are met may trigger both income tax and a 10% early withdrawal penalty. The key shift that happens at retirement is this. You now control the timing of your income in a way you never did during your working years. You can choose when to pull from which accounts. That flexibility is valuable, but only if you understand how each withdrawal affects your tax bracket, your Social Security taxation, your Medicare premiums, and your overall financial picture. A large, unplanned withdrawal in 1 year can simultaneously push you into a higher bracket, increase Social Security taxation, and trigger IRMAA surcharges 2 years later. Change number 5, the Social Security earnings test. If you claim Social Security before your full retirement age and continue to work or bring in employment income, SSA applies an earnings test that can reduce or withhold your monthly benefit. In 2026, the earnings limit is $24,480 per year for people collecting before their full retirement age. SSA withholds $1 for every $2 earned above that limit. The good news is that withheld benefits are not lost permanently. When you reach full retirement age, SSA recalculates your benefit upward to account for the months your payments were reduced. But the short-term cash flow impact can be significant, especially if you were counting on that income to cover monthly expenses. After full retirement age, there is no earnings limit and no withholding. The earnings test disappears entirely. Full retirement age depends on your birth year. If you were born between 1943 and 1954, your FRA is 66. For those born between 1955 and 1960, it rises gradually. Anyone born in 1960 or later has a full retirement age of 67. Now let me give you 3 specific things you can do right now to protect yourself. Step 1. Decide your RMD timing strategy before you reach the required age, not after. The most common and most expensive mistake is making the first RMD timing decision without fully understanding the downstream effects. Talk to a tax professional before you turn 73. Map out what happens if you take your first RMD in the calendar year, you reach the required age, versus if you delay it to April of the following year. In most cases, taking it in the earlier year, before December 31st, avoids the double RMD problem that caught Robert. Know the consequences before you make the call. If you have already missed an RMD, do not ignore it. Take the missed distribution as soon as possible. File IRS Form 5329 with your tax return. Attach a written statement explaining the reasonable cause. Request a waiver of the excise tax. The IRS has historically been willing to waive the penalty for first-time mistakes when there is a clear, legitimate reason. The form is free at IRS Gov, Forms Pubs, about Form 5329. Free help navigating this is also available through AARP Tax Aid, which you can find at aarp.org/taxaid. Step 2. Calculate your combined income before taking any large IRA withdrawal. Before you pull a significant sum from a traditional IRA, even for a good reason like home improvements, gifting, or a major expense, run the numbers on what that withdrawal does to your combined income. Add up your adjusted gross income, your non-taxable interest, and half of your Social Security. Then add the withdrawal on top. Does it push you above the Social Security taxation thresholds of $25,000 for single filers or $32,000 for married filers? Does it push you above the IRMAA thresholds of $103,000 or $206,000? If you are on the edge of one of those thresholds, spreading the withdrawal across 2 calendar years rather than taking it all at once can sometimes save thousands of dollars in taxes and Medicare premiums combined. Free tax counseling for seniors is available through the IRS Tax Counseling for the Elderly program and through AARP Tax Aid. These services are free, and the advisors understand retirement income situations specifically. Step 3. If your income drops significantly after retirement due to a life-changing event, file SSA Form SSA 44 to appeal your IRMAA surcharge. This is a protection that very few retirees know exists. If you had a large income year in the past and Medicare is now charging you elevated IRMAA premiums based on that old income, but your income has since dropped significantly because of retirement, a death in the family, divorce, or loss of income producing property, you have the right to appeal. You file SSA Form SSA 44, which is the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event form. You explain the qualifying life event, and SSA will use more recent income data to recalculate your premium. This can save retirees hundreds of dollars per month. The form is free at ssa.gov, forms ssa44.pdf. Let me close with something I want you to carry with you from this video. Retirement is not just a life change, it is a tax change. It is an income change. It is a Medicare change. The moment your paycheck stops, 5 different systems that govern your money start treating you differently. And the rules they use are not always explained clearly or explained at all. What I want you to take from today is this: the decisions you make in retirement are not independent of each other. An IRA withdrawal is connected to your Social Security taxes. A poorly timed RMD is connected to your Medicare bill 2 years from now. These things are a system. And when you understand how that system works, you can navigate it in your favor rather than getting caught by it. You now know the 5 changes. You now know Robert's story and the specific timing mistake to avoid. You now have 3 concrete steps you can take to protect yourself. But here is what I need to be honest with you about. These rules change. Congress passes new legislation. The IRS adjusts thresholds. Social Security updates earnings limits. Medicare recalculates IRMAA brackets. The system you understood today may look different a year from now. And YouTube notifications are not a reliable way to stay current. The algorithm does not care about your retirement security. It shows you whatever it thinks will keep you scrolling. Important rule changes that directly affect your monthly income may never reach your feed at all. That is exactly why I ask you to do one thing right now. Click the link in the description and join the Global Senior Alerts official WhatsApp channel. When you join, you will be able to download a completely free senior benefits protection guide. It covers RMD rules, Social Security taxation, Medicare, IRMAA, pension distributions, IRS forms, and more, all in the same plain language I used in this video. And you will receive real-time alerts the moment a significant rule change happens that affects your retirement income. Not a week later, not buried in an algorithm, right when it matters, no spam, no sales, just verified information from official sources that protects the retirement you worked your entire life to build. Share this video with someone you know who is approaching retirement or who just retired recently. The first few years are when these surprises hit hardest, and when the information in this video matters most. I am Jocelyn. Thank you for watching. Subscribe, turn on notifications, and I will see you in the next one. Take care of yourself. You have earned that.